All right, as promised, let's do this, answer some of your questions. Joe, I come to you first today from Brent in Minneapolis, Minnesota. Brent, I hope you're well. Thanks for the question. Is MetLife, Joe, a buy in this environment?
No, it is not. I certainly would not allocate in the insurance space towards MetLife. I would go Progressive, ticker symbol PGR. You've heard me speak about that frequently. That's personal and commercial auto insurance versus MetLife that unfortunately is very tethered to the shape of the yield curve. And given where that yield curve is right now, it is not a favorable condition for MetLife.
Okay. John Najarian, I come to you now. Ron in Calgary, Canada. Thank you so much for the question. A sold covered call on FANG stocks that have now rallied have risk of being called away. Do we buy back or get called away and wait for a pullback to pick back up the names?
Well, he is Canadian, Scott, and so I don't know what their tax code is versus ours. However, if I were in a taxable account, I would buy those calls back and roll up, sell a higher strike against the stock that he owns. If he's in a non-taxable account, then I would let it get called away and wait for that pullback that Liz Ann and others have talked about.
All right, that's great advice, John. Thank you. Carrie, to
Thank you
from Deborah in Houston, Texas. Hope you all are doing well down there as well, as best you can. What has happened to Stryker? Should I hold, even though it has been down so much of the last month? What do you say, Carrie?
Well, Stryker is a great company. Deborah, I think it's wonderful that you own it. You know that it's an elective surgery, hips and knees, and those kind of surgeries have been postponed. It's only 23% down from its all-time peak, I believe. So it's suffered much less than many other companies and other sectors, such as financials. I mean, we could go down the list. So Stryker's outperformed. I think it's a hold here. I wouldn't sell it at all. There's pent-up demand. I know that they are not considered essential or necessary surgeries, but if you ask a patient who needs a hip or knee replacement, they definitely think it's essential to them. And so I would hold it right here, and you'll see that over time their business will come back.
Okay. And Liz, to you from TJ Leonard, what sectors are most likely to see consolidation as a result of the virus?
Hi, TJ. So the sector, first and foremost, that'll see consolidation is energy as we wait for global demand to pick back up. But we're also going to see it in travel and leisure. And then I think real estate, particularly on the commercial side, is going to take a pretty big hit here.
Okay. Jim Lebenthal, to you. Jim's now on the phone, by the way. We're having some issues with his feed. Jim, from Michael in North Carolina, should I worry about being in municipal bond funds in the future? What are good bond alternatives? That's a good question, and that's right in the Lebenthal universe.
Yeah, it is, and we've been doing a lot of thinking and talking about it at Cerity Partners. And basically where we come out with this is that the investment-grade municipal bond space is pretty safe right now. You've got the Fed backstopping things. You talk about essential services, whether they're throughways, tolls for bridges, mass transit. The governors and the federal government want to make sure that these are around when we recover from this. So in investment-grade land, you should feel pretty good. High-yield muni is something that's a little scary right now, and I don't think you need to be in high-yield muni for any reason. Okay.
Round two. Joe Terranova coming back to you from Ron in Pleasant Valley, New York. Boy, New York's been hit hard. I hope you and your family are well, Ron. Your thoughts on Eli Lilly, Joe?
My thoughts on Eli Lilly is that I am long Eli Lilly. I maintain the position. It has broken out as one of those V recovery stock names, trading at highs. Price target raised to 160 from 145 recently by Cowen. Diabetes franchise, very strong. It is a healthcare name that gives a little bit of a diversification story to the equity investor beyond just the technology and consumer discretionary-led names that we see taking the market higher now.
Okay. Jim Lebenthal, to you, coming back to you on the phone from Jerry in Indiana. Thanks for the question, Jerry. Caterpillar, buy, sell, hold on CAT, Jim.
Hold on to it for now. Look, in the long run, I can see reasons that this will perform. Maybe we get an infrastructure bill. And, a lot of us think that supply chains will relocate from overseas to the U.S. That will demand some Caterpillar earth-moving equipment. But in the short run, I think this is a value stock that has punched above its weight class recently. I still own it, but I wouldn't be surprised to see it dip down towards 100. That's a place that you might add to it.
Okay. John Nigerian, I don't have a name on this one, but it says I've made 50% on Square in the last month. Should I sell or hold on for the long term?
I think you take the money and run here, Scott. Up until today, I was in the stock. I finally decided, I was going to get out. I was in calls, so I sold those calls. I think one of the issues here, Scott, is where do you use Square? And obviously in a lot of taxis and in a lot of other services that are not being used, or certainly well below previous use cases, I think that's why Square will suffer a little, maybe a lot, and that's why I'd pull back and take that money off the table.
Okay. Carrie, coming to you now from Robert in Miami. Robert, thanks for the question. Hope you are well as well. What are your thoughts on regional banks, Carrie?
So, Robert, it's a very interesting question. It's the opposite of a question such as, what do you think of Amazon or Netflix, that are at all-time highs, more or less, and everything's great for them. The regional banks are really in tough shape in terms of their stock prices down on average 45%, some of them more. And they are looking at regions, because they're regional, some of which are extremely vulnerable over the next year. So let's say you want to differentiate between a regional bank in Orlando, where, of course, their clients, their borrowers would be resort and tourist related to Disney World. I would think you have to look at that carefully and decide what % of their business they could lose because of bankruptcies, and is the stock price cheap enough? So I would look at individual names. We only own First Republic because their clientele is less vulnerable. It's high-end clientele in certain regions of the country, not all. We've owned Silicon Valley Bank in the past, don't now, but you could look at that because it's down just like the group, has vulnerability to Silicon Valley. But I think you can make determinations on how cheap a stock is, what the multiple is relative to a recovered earnings level, and you might be fine just on valuation.
All right. Liz, lastly to you. You're a Packers fan, right?
Of course.
Yeah, that's what I thought.
Through and through.
All right, Brian in Green Bay, Wisconsin. He has a question for you. This is rigged, apparently. We must have known that you were a Packers fan. With a volatile market, as we now have, I've moved my money from in my 401k from equity mutual funds into a Vanguard 2030 fund to be a little safer. You think this was a good move? I have 7.5 years until retirement. Brian, we appreciate the question. We wish you well. We want football back as much as you do. I know that.
Yes. Hi, Brian. So it sounds like you de-risked and went from more of 100% equity to more of a 70-30 allocation, which I think was a good move in volatile times. What I would caution you on is that a Vanguard fund like that is full of index products. So you're going to have passive exposure in that fund, and I'd want you to use that as a core and then supplement it with some more active exposure to get high-quality exposure.
All right, good
Go
stuff.
Packers.
Yeah, all right. I got one more. I'm going to throw it out there. And who owns Visa? Is it Joe?
I do.
I do not.
Oh, Carrie, you own Visa. Okay, I've got another one. It's just our bonus round. One more from Willie, who says, will Visa be a good investment, or will they be at risk for those who won't be able to pay their bills in the short-term future? I mean, it's a legitimate question when you're talking about credit card stocks.
Of course. Yeah, of course it is. So we like Visa. It's underperformed some of its peers because, it's a tech financial. We think it's a great company. If you don't own the stock, then we might buy half a position here. If it goes lower, buy a little more. But we believe that it's a core holding. Anybody own Chegg? No?
No.
All right. We'll have to look that one up. That's from Clay Wasson. He tweeted that to us as well.